This video is going to introduce you to the concept of cash flow budgeting. Please read Chapter 13 before you listen to this video or any of the other videos related to the cash flow budgeting. Please read that chapter first and then come back and listen to the videos. Do this in order. It'll make quite a bit more sense. In farm business management, a lot of times in financial management, we use the term the 3 R's. The 3 R's, sometimes referred to as the 3 R's of credit, are risk, returns, and repayment capacity. Now you can think about this from two viewpoints. You can think about it from the viewpoint of the farm manager, or you can think about it from the viewpoint of a lender to a farm or ranch operation. When we talk about risk, we're really talking about what does the farm own that would eliminate risk associated with low prices, low yields. From a banker standpoint, if they loan money to the farm, the risk is simply what if the farmer doesn't pay? What do they have as collateral? So when you think about risk that way, you can actually relate risk to a balance sheet, because a balance sheet is the assets and liabilities of the farm. So in a sense, it measures risk because the balance sheet shows what that farm owns, what it owes. It simply will tell a lender, well, look, if this borrower doesn't pay the loan back, what do I have in terms of to fall back on in terms of collateral? It tells the farm manager, look, if I have a bad year, can I absorb that bad year with the assets that I own relative to the amount of debt? The second of the 3 R's is returns. Well, returns simply is a measure of profitability. In other words, am I making any money? What kind of return am I getting on my assets? What kind of return am I getting on my equity? In other words, am I making a profit? So you can relate that to the income statement. So that's the second of the 3 R's. Pardon the handwriting. The idea of repayment capacity is a little bit different. Repayment capacity in agriculture is an interesting or a very important concept, because as you folks know, if you're running a farm or ranch, money doesn't come in and go out in a nice, neat, equal pattern. In other words, if you have a job where you work for a monthly salary, your cash inflow every month is about the same. And if you're just living as a family consumer, you spend approximately the same amount of money every month, not necessarily exactly. But in a farm or ranch farm business, money doesn't come in and go out in a nice uniform method. If you're a corn or soybean farmer in northeast Louisiana, you produce that crop one time a year. Now, you may or may not sell it right then. You may store it and sell it later, but still money comes in large lump sums. It doesn't come in nice and neat January to December. Same way with the money you spend on that farm. You don't spend a nice equal flow from January to December. Money goes out some months in large amounts and some months not so large amounts. So the idea of repayment capacity is developing a financial statement that tries to summarize when there's going to be money in, when there's going to be money out, and when there's going to be money available, when you're going to need to borrow some money. So the idea of repayment capacity is simply the idea of money flows. Now, it's not income. It's not expenses. It's not a determination of profit. It is simply money flows in and out. When you talk about repayment capacity, we talk about a cash flow statement. So really now, when you boil that down in a summary, the 3 R's of farm management are risk, returns, and repayment capacity, and those are related to the three primary financial statements: the balance sheet, the income statement, and the cash flow. And of course, what you learned way back in the first of this course is that all of those statements are developed using the chart of accounts. Now, cash flow can actually be in two different categories. A cash flow statement, it can be historical, in other words, what happened last year, or it can be projected, in other words, what do you think is going to happen in the coming year. Now, historical cash flow is really quite easy if you stop and think about it. You go look at your checkbook. Go look at your bank account. Go to your online bank account and look at every month and see when money come in and when money went out. But projecting a cash flow is a little different story because what you're going to try to do is based on the previous years, you're going to try to project how much money you're going to spend in each of the months of the coming year and how much money is going to come in each of the months. You can sit down with that projected cash flow and simply say things like, "Oh, I'm going to buy large inventories of seed in February, or I'm going to buy a huge inventory of diesel in early March, or I'm going to harvest my corn in August. I think I'll probably sell it in September." Or, in other words, there's lots of different ways in terms of that projected cash flow to estimate when money's going to come in and go out of the business. In a cash flow, it's important to realize that we don't want to use the words income anymore. Okay? That's not what we want to do. We want to call it inflows because we're talking about anything that represents money into the business. We don't want to use the word expenses anymore in a cash flow. What we want to use is outflows because it's anything that money flows out of the business. Let me give you some examples here. If you're a corn farmer and you sell corn and you get cash check from the elevator, that is income. Sure, it's also an inflow of money. But if you using the accrual-based accounting system that has been taught in this course at the end of a year and you've got corn in storage, that inventory amount, how it changed from the previous year is income, but it's certainly not an inflow, okay, because you hadn't sold it. Let me give you another example. Suppose you were going down to the bank and you want to buy yourself a new tractor. Tractor costs 100 grand and you're going to borrow 80 grand from the bank. Well, the bank's got to put $80,000 into your bank account. That's not income, but it is an inflow of dollars. Okay? Under an expenses, one of the classic examples of expenses is depreciation. Depreciation is an expense, but it's not an outflow of dollars because you don't write a check for depreciation. When you write a check is when you bought that tractor. So if you bought that $100,000 tractor and you borrowed 80,000, you'd have an $80,000 inflow when the bank put the money in, and you'd have a $100,000 outflow when you wrote a check. So depreciation never shows up on a cash flow. It's a non-cash item. Inventory changes in prepaid expenses and accrued interest and things like that are not cash entries. So they are expenses. Accrued interest is an expense on the income statement, but it's not an outflow. It'll never show up on a cash flow statement because it's not a money flow. So the cash flow, what we need to understand about a cash flow is that it's anything that records or projects is the better word, projects money coming into the business and money going out of the business. Most cash flows in agriculture will teach you that you'll have cash receipts from farming. You'll have payments when you or purchases, excuse me, you'll have loans made for the purchase of capital items. Sometimes you sell old capital, like sell an old piece of machinery or something. All of those things are cash inflows. At the option of a farm manager, you might want to put non-farm income into your cash flow. If your farm you think needs some of that money to operate, then you probably should put in a row in your cash flow for non-farm income. That would be like a spouse working off the farm. On the outflow side, of course, all your cash expenses are outflows. If you write a check to buy a new capital expense like land or machinery or breeding livestock, that's an outflow. When you pay principal and interest payments on term debt, that's an outflow. If you pay your income taxes and your self-employment taxes, that's an outflow. If you take money out of the business to live on, that's an outflow. So you see the cash flow statements is a summary of money in and money out. Usually in agriculture, we teach cash flow on a monthly basis so that you get some idea of when you need money and when you're going to have excess money. In other words, when there's going to be a surplus of dollars, when there's going to be a shortage of dollars by months. Some cash flows and very large operations require cash flow on a 2-week basis so that the lender can more closely monitor the buying and the selling and the movement of money in the farm business. There's going to be a series of videos now that's going to explain how a cash flow would look and how you actually construct a cash flow. So after you've read chapter 13 and listened to this short video, then you'll want to open some of those and watch how you would actually set up and create a cash flow statement.